In exercise 4-13, we did the direct method. This time we're going to prepare the cash flow statement using the indirect method. And that's the way that most people actually do it. And so in order to get the direct method, and this will just be the operating activities, the financing investing activities are still done even though we use the direct method. We're still done the direct method even if we use the indirect method for operating. To do the indirect method, we start with the net income. So we begin with net income, and we are told here it's $17,300. Okay, the next thing that happens is you add back depreciation and amortization. Now, some people say that depreciation and amortization is a non-cash expense. That's not exactly true. It's just that the cash expenditure is not linked directly to the expense. So I may borrow money in order to buy a piece of equipment. I may buy a piece of equipment on an installment note from a company directly, or I may have cash from operations I use to buy that piece of equipment right up front. And so the cash outflow is not directly linked to the depreciation. Then, of course, the depreciation and amortization is over a period of years. So the next thing that we do is we add back the depreciation and amortization. And I don't think we have any amortization in this problem, but we do have depreciation of $7,800. So we add that back to it. Okay, now we will do the changes. And I'll talk about each of these as we go along. And so the next one that we have in line is we have an increase in accounts receivable. So if your accounts receivable goes up year over year, what has happened is you have not collected as much cash as you have sold. Remember, we keep our income statement on the accrual method. So it's when we sell the good or the service is when we record the revenue, but we don't necessarily collect it then. So if accounts receivable goes up, you have not collected as much as you've sold. And so an increase in accounts receivable will be a decrease in cash. Now the sign delta here, triangle for delta, just means a change. And we're going to record that change. Accounts receivable went up. That means cash went down vis-a-vis net income on that. The next one that we have is a decrease in inventory. So likewise, if inventory goes down, that means we didn't replace it, so we didn't spend cash for it. So a change in inventory will go the opposite direction to cash. So a decrease in inventory will be an increase of cash, and that is $5,500 on that. The next one is a decrease in prepaid insurance. So we had prepaid insurance. Now it shows up as an expense, which is part of net income, but it didn't cost us cash this year. It cost us cash last year because it was prepaid, but it didn't cost us cash this year. So a change in prepaid insurance, a decrease would be an increase in cash. And that was $1,200. The next one, we have a decrease in salaries payable. So this is liability. So this means that we paid more than we actually incurred as an expense. Okay, so the change in salaries payable is going to go the same direction. So we have a decrease in salaries payable, we'll have a decrease in cash. In just a moment, I'll give you a good way to remember all these. Then finally, we have an increase in interest payable. So we recorded interest payable as an expense, but we didn't actually pay it, so we're not out the cash for it. So an increase in interest payable would be an increase in cash. And that was $800. Now we add these all up, we'll get our net cash from operating activities. And that's $25,900. All right, now here's a good way to remember this. Start with net income, add back the depreciation and amortization expense. Okay, now you go back to your accounting equation. Remember the accounting equation, assets equals liabilities plus owner's equity. All right. So if it is an asset, a current asset, you move the opposite direction. So an increase in inventory would be a decrease in cash. An increase in accounts receivable would be a decrease in cash. On the other side of the equation, you have your liabilities and owner's equity. An increase would be an increase in liabilities would be an increase in cash. A decrease in liabilities would be a decrease in cash. The thing that you have to be careful of on the cash flow statement is when you have unearned revenue. I call unearned revenue a masquerade account. It says it's a revenue, but it's not. It's a liability. You owe somebody something on that. And so just make sure that those accounts that say they're one thing but are actually another, that you account for them in the category that there should be. All right, that's exercise 4-15.